The market has realized that, and you can feel it in the tape again, because when the pressure finally flips, it doesn't whisper, it shouts. Tuesday, February 10th. Because on the chart, you can make a strong case that the market just finished a reset. Not a collapse, a reset. The kind where momentum gets cooled off. The kind where indicators stop screaming. The kind where everybody's confidence gets wrung out like a towel, and then you get the breakout attempt. Now, I'm not saying it has to be a straight line from here. It rarely is. If anything, the market loves to make you earn it. It'll push, it'll pull back, it'll make you second guess us your own eyes. But what matters is whether this breakout holds when the excitement fades. That's the first cliffhanger. Because if silver holds above that broken trend line and doesn't immediately roll over, you're not looking at a random bounce. You're looking at a change of character. And the giveaways are classic. You've got that narrowing pattern that spent days compressing. You've got volume waking up right as price clears the ceiling. You've got momentum lines crossing back into a friendlier posture. And you've got that not too hot, not too cold feel in the strength readings. It's like the market took a deep breath. But here's the part most people miss. Even when the chart looks good, the chart can still be lying if the move is just paper games, if it's just positioning, if it's just an option squeeze, if it's just short covering with no follow through. So we need a second confirmation. And that confirmation is whether the market keeps buying when it's no longer exciting because everybody buys the breakout candle. The real money buys the boring candles. So if tomorrow is quiet and the buyers still show up, that's when you start taking it seriously. Now, let me zoom in on one thing people argue about: volume. You'll hear folks say volume is fake or volume is everything. The truth is, volume is a clue, not a verdict. When you see volume drying up during the decline and then rising on the push higher, that's often a sign that selling is tiring and buying is taking the baton. Not always, but often. And when you combine that with a momentum cross where the faster line turns up through the slower line plus a strength gauge that's not in the danger zone, you start building a case. A case, not a guarantee. So yes, bullish, but discipline bullish. And that's important because silver doesn't just reward confidence, it punishes overconfidence. Now gold. Gold has been acting like the adult in the room. Gold tends to move first, and silver tends to follow with attitude. And lately, gold has been hovering right around that psychological line where the whole world suddenly starts talking again. You know, the 5,000-ish area that turns headlines into adrenaline. And what's interesting is gold isn't acting exhausted. It's acting like it's trying to build a floor. And floors are what turn rallies into trends. So, if gold is building a floor and silver is breaking out of compression, what does that usually mean? It usually means the metals complex is trying to reaccelerate. But second cliffhanger, sometimes gold can be stable, while silver fakes you out. Silver has a habit of running ahead, then snapping back, and making everybody look foolish. So we watch the behavior, not the hype. Now let's talk miners, because miners are the part of this story that can either confirm the move or embarrass it. Miners are weird. Sometimes they lead, sometimes they lag, sometimes they move like they're asleep, and then one day they wake up and outrun the metal itself. And that relationship matters because miners are basically a leveraged bet on the metal plus a bet on management plus a bet on costs plus a bet on politics. So they're not clean, but they're informative. Today, you're seeing gold miners act a little more enthusiastic than gold, and you're seeing silver miners act a little less enthusiastic than silver. And that difference is the kind of detail that tells you where fear still lives. Because if silver is ripping and the silver miners are only kind of joining the party, that can mean one of two things. Either the miners are undervalued and they're about to catch up, or the market doesn't trust the move yet. And you have to be honest about both possibilities. Now, I lean toward the catch-up scenario, and I'll tell you why in a second. But before I do, let me ask you something. Are you more comfortable owning the metal itself or owning the companies that dig it out of the ground? Tell me in the comments. I want to see where your head is at. All right, here's why the undervaluation argument is even on the table. When you look at the ratio of silver miners to silver itself, you can make the case that it's still sitting in a depressed zone, not end of the bull territory, more like people still don't believe it territory. And that's where the opportunity usually lives, because the end of a bull market is when everyone believes. The early and middle parts are when half the people are still arguing about whether the bull market even exists. Now let's talk about the gold to silver ratio, because this is one of those indicators that gets ignored until it suddenly becomes obvious. When that ratio is up in the triple digits, historically, that's not usually a sign you're late. That's usually a sign silver is still being treated like the unwanted stepchild. When that ratio collapses down toward the 30s and 20s, that's when you're often closer to the hot, frothy phase. Right now, we're still sitting a little above 60, give or take, which tells you we're not in the everybody is all in on silver stage. We're more in the silver is waking up, but belief is still uneven stage. And if that ratio keeps sliding lower over time, it usually means silver is outperforming. But again, it rarely happens in a straight line. It happens in bursts with pullbacks that feel personal. Now that's the technical side. Let's bring in the part that makes people uncomfortable, the physical side. Because metals are not just squiggly lines on a screen. They're atoms, their inventory, their transport, their vaults, their delivery schedules, their rules. And sometimes the rules get tested. What I've been watching is the tug-of war between paper convenience and physical reality. And recently, you've had a lot of chatter about physical availability, especially in Asia, and especially in the way local pricing can diverge from Western pricing for stretches of time. Sometimes that premium widens, sometimes it compresses. And when it compresses while price is rising, that can tell you something subtle. The market is pulling metal. Arbitrage is working overtime, and prices are trying to snap back into alignment. Now, based on recently published numbers, there's also been talk of a noticeable drawdown in reported vault inventories on the Chinese side. One of those day-over-day moves that makes you sit up a little straighter. But let me be clear, single-day inventory shifts can be noisy. They can be paperwork. They can be reclassification. They can be metal moving from one bucket to another bucket. And if you build a whole world view on one print, you're going to get humbled. So here's the right way to look at it. If you see repeated drawdowns over time, if you see a pattern, if you see the available pile thinning while demand stays stubborn, that's when it gets serious. And yes, we've also been hearing from dealers, large dealers, that physical order flow picked up hard during the correction. Some people waited, some people pounced, and the backlog talk is real. Not because the world ran out of metal, but because demand can arrive in waves and logistics can't teleport. If you bought that dip, by the way, tell me how you approached it. Did you scale in? Did you wait for a specific level? Or did you just buy when it felt ugly? I'm genuinely curious. Now, that brings us to the US side of the story, because over here, the conversation always circles back to the big futures exchange warehouses, where metal gets categorized in ways that confuse people on purpose. You've basically got ready to go metal and stored, but not offered metal. That's the simplest way to think about it. And the trap is when people look at the total and assume it's all deliverable. It's not. Some of it is basically parked. It's in the building, but it's not on the shelf for sale. Now, the spring delivery month is the one everybody stares at, because open interest can look enormous compared to the deliverable category. You do the math and you go, wait, how is that even possible? And when you multiply tens of thousands of contracts by 5,000 ounces each, you can quickly get to exposure that sits in the hundreds of millions of ounces. That sounds ridiculous, because it is ridiculous. It's leverage. It's a confidence structure. But here's the skeptical alternative, and you need to hear it. Open interest is not the same thing as delivery demand. Most contracts don't go to delivery. They get rolled, they get closed, they get netted. That's how the system has worked for a long time. So I'm not in the camp that says any day now the exchange explodes. Could it happen one day? Sure. But if you trade like it must happen next month, you're going to burn yourself out. The more practical point is simpler. The structure is leveraged. The structure relies on confidence, and confidence is a fragile thing. When confidence weakens, you don't need the whole system to fail to get a big reparic. You just need a few big players to demand certainty instead of promises. And if the exchange ever had to lean on cash settlement, meaning here's your money, sorry about the metal, that wouldn't just be an operational detail. That would be a credibility moment. Now, I'm not predicting that. I'm saying that's why physical tightness matters. Not because it guarantees drama, because it changes bargaining power. If you're holding the thing everyone needs, you're not negotiating from weakness. Now, let's zoom out and talk about the bigger financial backdrop, because this is where metals stop being a trade and start being a theme. Across the world, central banks have been buying gold at elevated rates over the past couple of years. That's visible in the public data. And it matters because central banks don't buy gold because they're bored. They buy it because they're thinking about sovereignty, settlement, and trust. And recently, there's been fresh talk, rumors, testimonies, public questions, and hearings about whether major powers are exploring digital settlement instruments that are backed by something tangible rather than backed by pure faith. Now, to be fair, a lot of that is speculation. It's political theater sometimes. It's signaling sometimes. But even the discussion is important because it shows you what people are worried about. They're worried about debt. They're worried about sanctions. They're worried about payment rails. They're worried about what happens when the old system doesn't feel as neutral as it used to. And when those worries rise, gold benefits. Not because gold pays you interest. It doesn't. Gold benefits because gold is a settlement asset that doesn't need somebody else's permission. Silver gets pulled along for the ride, but with extra volatility because silver is also an industrial metal. And that industrial side is not a small side. Think about electrification. Think about data centers. Think about solar. Think about sensors. Think about the quiet, relentless build-out of stuff that needs conductivity. Even if you don't care about monetary theory, you can't ignore that the world is using more silver in more ways. And the supply side is not exactly a faucet you can open overnight. Mines take time, permits take time, refining takes time, and when investment demand shows up at the same time as industrial demand, that's when the market starts to feel tight. Now, I want to add one more layer of context that a lot of people miss. Cost pressures, energy costs, labor costs, equipment costs, financing costs. Those feed into mining margins. So, miners can lag even when the metal pops because the market is pricing not just higher revenue, but also higher headaches. That's why the miner-metal ratio can stay depressed longer than people expect. And then when it turns fast. Now, let's do a quick cultural aside because this was funny to me. Over the weekend, there was that big televised football game, and there was a moment where a message flashed that basically nudged people toward buying gold and silver. And I'm not saying it was some grand plot. I'm just saying it was interesting because when metal talk starts showing up in places that are normally pure entertainment, it can be a sign that the conversation is leaking into mainstream attention. Sometimes that marks a top. Sometimes it marks the beginning of a broader wave. Which one is it this time? That's another cliffhanger. We don't know yet. Now, let's shift gears into geopolitics, because this is the part where markets can go from technical breakout to macro stampede in a heartbeat. There's been ongoing noise around negotiations with Iran, and there have been reports of incidents near naval assets. And there's also this recurring pattern where talks stall, statements harden, and suddenly everybody starts floating options. And the market doesn't wait for certainty. The market prices risk. There's also been talk of Heil meetings in Washington with key Middle East leaders. And when those meetings happen in tense periods, it can either be a path to cooling down or it can be part of the choreography before something hotter. Now, I'm not going to pretend I know the script that gets chosen. What I do know is that energy markets react first, and then currencies, and then safe havens. Oil has been building its own kind of compression. It's been hanging in that mid-60s area, not doing much until suddenly it does. And it's sitting in a zone where one headline can change the chart in a single day. And here's why that matters for metals. If oil spikes, inflation expectations can spike. If inflation expectations spike, bonds and the dollar can move. If the dollar moves, gold and silver can respond. And if people start feeling like global stability is wobbling, safe havens get bid. Gold loves that environment. Silver can love it too, but silver will make you suffer first. Now, I'm not here to doom scroll you. I'm here to talk probabilities. One probability is de-escalation, another probability is escalation. And the oil market is basically sitting there waiting for which script reality chooses. If the Strait of Hormuz gets even partially disrupted, the energy market doesn't need a full shutdown to panic. It just needs uncertainty about flow. But again, don't trade headlines like they're certainties. Trade them like they're risks. Now, quick detour, because a lot of you have been asking about Bitcoin, and I get it. Bitcoin is the other hard asset narrative that people argue about. And right now, from recent market updates, Bitcoin is hovering in the high 60s area, but it's been struggling to reclaim key broken support. It's had that classic breakdown, bounce, fail look. Could it turn around? Of course, but in the very near term, it looks heavier than the metals. And that's interesting because there are periods where Bitcoin acts like a hedge, and there are periods where it acts like a risk asset. Right now, it feels more like a risk asset that's losing momentum. And that can matter because when risk assets wobble, money sometimes rotates into gold first, then silver later. Now, let's bring this back to what you actually do with this information because I don't want this to be entertainment with no utility. First, if you're trading, you watch the close. You watch whether today's strength sticks. You watch whether tomorrow follows through or fades. Second, if you're investing, you care less about the next candle and more about whether the broader trend structure is intact. Third, if you're stacking physical, you already know the game isn't about flipping in a year. It's about changing the way you store work. And yes, I know that sounds philosophical, but it's practical. Because when you hold something tangible, you remove a layer of counterparty risk. Now, another question for you. If you had to pick just one, are you more focused on building ounces, or are you more focused on timing the price? Comment that because the answers will tell me what kind of content you want more of. All right, let's talk targets because I know people love targets. Here's my view. In a bull market, the point is not to nail the exact top. The point is to understand that the market can go further than your imagination, and it can also punish you for arrogance along the way. If the breakout holds and if the complex keeps building, it would not shock me to see silver revisit the prior peak zone within weeks, not months. And later, if this cycle really matures, you could see silver trade with a 100 handle again and then some. But I'm saying that as a scenario, not a promise. Same with gold. If gold keeps holding around that big psychological line, and if macro uncertainty keeps rising, gold can print levels that would have sounded absurd not long ago. And when that happens, the people who sold because of volatility will be watching from the sidelines, trying to get back in at a worse price, which is why patience matters. The market doesn't usually reward the loudest voice. It rewards the steady hand. Now, I want to address the "is now a good time to buy" question because people always ask it, and it's a fair question. I can't tell you what to do with your money, but I can give you a way to think about it. Buying after a breakout is less cheap, but it's also less uncertain. Buying during a correction is more uncertain, but potentially more rewarding. So some people use a simple approach. They buy a little when the trend is confirmed. They buy more on pullbacks. They don't go Allen on one day. They don't blow themselves up with leverage, and they give themselves time. And if you're successful, share your success story in the comments so others can stay motivated. Now, on the diversification point, because I know some of you are heavy metals and some of you want to spread out. Energy is one of those areas that can act like a hedge if geopolitics flares or if inflation reaccelerates. Some people prefer owning producers. Some people prefer broad sector exposure. Some people even like income-style vehicles that try to generate cash flow. But remember, complexity is not a virtue. If you don't understand it, don't touch it. And then there's uranium, which keeps coming up because of the conversation around grid demand, electrification, and data centers. Nuclear is a touchy topic politically, but from a physics standpoint, it's reliable baseload. If large buyers keep leaning into that reality, the fuel cycle becomes a story again. None of that means you should chase. It means you should pay attention. Now, I want to throw in one more perspective that helps keep you grounded. Sometimes the biggest metal rallies don't happen because everyone suddenly loves gold and silver. They happen because trust in everything else gets a little shakier. That's when hard assets stop being a niche and start being a default. And that can come from inflation. It can come from debt stress. It can come from geopolitical friction. It can come from financial plumbing issues, or it can come from all of the above stacked together. So when you hear people say, this is just a technical breakout, I get it. And yes, charts matter. But the reason charts matter is because they're a picture of human behavior reacting to real-world pressure. Now let's circle back to the main thesis and tighten it up. The thesis is not silver is up today, therefore we're rich. The thesis is the technical structure looks like it's transitioning from correction to continuation. The miners are giving mixed but improving signals. And the physical narrative, while easy to overhype, has enough smoke that it's worth watching. Layered on top of that, the macro and geopolitical environment is the kind that historically keeps hard assets in focus. Debt questions, settlement questions, currency competition, and geopolitical friction. That's the setup. Now, a few very specific things I'm watching over the next couple of weeks, just so you know what follow-through looks like in real life. 1. If we get a pullback, does silver pull back gently? Or does it fall like it's trying to punish everyone who bought the breakout? A gentle pullback that finds buyers is constructive. A violent dump that slices back under the breakout line is a warning shot. 2. Do the mining shares start acting like they're being repriced, or do they stay sleepy? When miners finally believe, they tend to move in clusters. You'll see multiple names and multiple baskets start lifting at the same time, not just one or two. 3. Watch the warehouse reports. The boring PDFs that nobody reads, not because every daily wiggle is meaningful, but because trends show up there first. If the deliverable category keeps shrinking while total ounces look fine, that tells you metal is being parked, not offered. If eligible metal quietly migrates into registered, that can tell you participants are preparing for delivery. And if the opposite happens, it can tell you they're trying to avoid it. 4. Watch the delivery month chatter with calm eyes. Yes, the open interest can look huge. Yes, the contract size is 5,000 ounces. Yes, the math makes for a dramatic story, but the real signal will be whether an unusually large slice actually stands for delivery instead of rolling. That's the difference between noise and stress. 5. Pay attention to the oil relationship. Lately, you can buy a barrel of oil for less than an ounce of silver. Historically, that hasn't been a stable condition. It doesn't prove what happens next, but it does hint that either oil is underpriced, silver is overpriced, or the world is about to re-prick something. And with geopolitics simmering, I'm not ignoring that. And on the digital asset rumor side, here's my skeptical take. Even if a major country wanted a gold-linked token, building trust in it is not instant. Trust takes years. Liquidity takes years. Rule of law, custody, convertibility, those details matter. So, I'm not buying the idea that one announcement flips the global order overnight, but I am watching the direction of travel. Because when policymakers start openly discussing backing and collateral, that's an admission that pure confidence isn't feeling as sturdy as it used to. And one more practical thing, don't let a good day trick you into speeding up your plan. If you're accumulating, keep your pace. If you're trading, keep your risk small. The market can hand you a gift today and invoice you tomorrow. Stay calm, stay liquid, and stay intentional. That's how you survive the part nobody posts online. Now, the biggest risk to the setup is simple. It's a sudden, sharp reversal that breaks the breakout and turns today into a fake out. That's why I keep talking about follow through, because the market loves to trick the maximum number of people. So watch the retest. Watch whether buyers show up when it's boring. Watch whether the miners start acting like they believe. And watch whether gold holds its floor while silver tries to sprint. If that happens, you're going to see the narrative flip fast. And the same people who ignored the move will suddenly start acting like they've been here the whole time. Now, before I wrap up, I want to thank you for being here, for supporting the channel, and for keeping the comment section alive. It matters more than you think. If you haven't subscribed yet, do it now. It takes a second and it helps a lot. And if you enjoyed this, hit the like button because it tells the algorithm we're worth showing. All right, I'm going to keep watching the close, keep watching the follow through, and keep watching the physical signals for any real stress. And remember, none of this is financial advice. I'm sharing how I interpret markets and public information for education and discussion. Do your own research, consider your situation, and if you need personalized guidance, talk to a licensed professional. Take care. Bye.